Artificial intelligence was supposed to make big tech more profitable. Instead, it is forcing the world's richest companies into one of the most expensive infrastructure races in corporate history. Data centers, specialized chips, power plants, fiber networks, and cooling systems are consuming hundreds of billions of dollars. Now investors are asking a question that was almost unthinkable 2 years ago. What happens if the AI revenue does not arrive fast enough? Alphabet's latest earnings brought that fear into the open. Google's parent company reported strong growth across search, advertising, and cloud computing. Revenue increased 24% from a year earlier. Google Search revenue rose 17%, and Google Cloud revenue jumped 82%. By almost every traditional measurement, the business was performing exceptionally well. But Alphabet's shares still fell sharply. The reason was not weak demand. It was the price of supplying that demand. Alphabet's capital spending has climbed so quickly that the company reported negative free cash flow of approximately $5.9 billion for the quarter. Reuters described it as Alphabet's first quarterly cash burn since becoming a public company. That is an extraordinary change. Google was once considered one of the greatest cash-generating machines ever built. Every search required relatively little additional cost, while advertisers competed to appear beside the results. The company could serve billions of users through an extremely profitable digital platform. AI changes those economics. A traditional Google search retrieves and organizes information. A generative AI response must run a much larger computational process. It uses expensive processors, memory, electricity, networking equipment, and data center capacity. The answer may appear instantly on the user's screen, but behind it is a physical industrial system consuming real resources. The more people use AI, the more infrastructure companies must build. Alphabet now expects to spend roughly $180 billion to $190 billion on capital expenditures during 2026. That includes servers, data centers, networking equipment, energy infrastructure, and other assets needed to support its expanding AI operations. This spending is not necessarily a mistake. Google Cloud is growing rapidly, its AI backlog is expanding, and the Gemini application has hundreds of millions of users. The company says it cannot currently provide enough computing capacity to satisfy internal and customer demand. The danger is that demand and profit are not the same thing. A customer may use more AI every month while the price of AI services continues falling. Competitors can release cheaper models, open-source systems can reduce dependence on proprietary providers, and improvements in efficiency can lower the amount companies are willing to pay for each task. Big tech must therefore build infrastructure before knowing exactly how much revenue that infrastructure will generate. This is similar to constructing an enormous factory without knowing the future price of the product it will manufacture. The factory may become incredibly valuable if demand remains strong and prices stay high. But if the product becomes a commodity, the company could spend billions building capacity that produces disappointing returns. Alphabet is not alone. Microsoft, Amazon, Meta, Tesla, Oracle, and other technology companies are also increasing investment in AI infrastructure. Reuters estimates that industry spending could exceed $700 billion. The number includes a vast network of chips, servers, data centers, electrical equipment, and construction projects. The companies face a strategic prisoner's dilemma. Suppose Alphabet decides to slow its spending. It could protect cash flow and improve short-term profits. But Microsoft or Amazon might continue building, gain more computing capacity, attract more developers, and lock major businesses into their cloud platforms. Suppose Microsoft slows down. Google could use the opportunity to make Gemini the default AI system across search, smartphones, productivity tools, and cloud services. No company wants to be remembered as the business that protected its quarterly margins while a competitor captured the next computing platform. So they continue spending. This is how competitive races become dangerous. Each company may be making a rational decision individually, yet the industry could still build too much capacity collectively. Something similar happened during the telecommunications boom of the late 1990s. Companies correctly predicted that internet traffic would explode. They spent enormous amounts building fiber optic networks. The internet did transform the economy, but many investors still lost money because infrastructure was built faster than profitable demand developed. The technology was real. The financial expectations were simply too aggressive. AI could follow a similar pattern. It may transform business, science, medicine, and entertainment while still producing disappointing returns for some of the companies funding the transformation. Alphabet's results show both sides of this possibility. Google Cloud is accelerating. Enterprise customers are buying AI infrastructure and AI services. Search advertising remains strong despite predictions that conversational assistants would destroy Google's core business. AI is already contributing to revenue growth. But the cash requirements are rising even faster. Investors previously rewarded almost any announcement involving greater AI investment. Spending signaled ambition. A new data center suggested future growth. A larger chip order demonstrated confidence. Now the reaction is changing. Investors want evidence that the spending will produce durable cash flow. They are beginning to separate AI usage from AI monetization. Millions of users can generate excitement, but shareholders eventually need margins, profits, and cash returns. The problem is especially important because the largest technology companies have enormous influence over the stock market. Alphabet, Microsoft, Amazon, Meta, Nvidia, Apple, and Tesla collectively represent a significant share of major American indexes. When investors lose confidence in their spending plans, the consequences extend beyond a single company. After Alphabet and Tesla revealed higher investment requirements, both stocks fell sharply and concerns spread to other AI-related companies. The market was no longer asking whether AI would grow. It was asking who would actually make money from that growth. The clearest winners so far may be the companies selling the tools required for the race. Chipmakers sell processors. Memory manufacturers provide high-bandwidth memory. Construction companies build data centers. Utilities supply electricity. Networking companies transport massive amounts of data. These businesses can earn revenue while cloud providers compete to determine who will eventually control the customer. During a gold rush, selling shovels can be safer than searching for gold. But even the suppliers face risk. Their current growth depends on big tech continuing to spend at an extraordinary rate. If one major company cuts its budget, the effect could move through the entire supply chain. The AI race has therefore created a strange economic system. Technology companies are spending because they cannot risk falling behind. Suppliers are expanding because their customers promise more spending. Investors are raising valuations because they expect AI to create future profits. And all three groups depend on the assumption that businesses and consumers will eventually pay enough to support the infrastructure. That assumption may prove correct. AI could become as fundamental as electricity or the internet. Every company may eventually use models to write software, operate factories, discover drugs, design products, serve customers, and manage logistics. Under that scenario, today's data centers would become the foundation of a much larger digital economy. Alphabet's spending might then look less like reckless cash burn and more like the construction of a global utility. But there is another possibility. AI models may become cheaper and more interchangeable. Customers may switch easily between providers. Open models may reduce pricing power. The revenue could grow while profit margins remain thin. In that world, big tech would have built enormously expensive infrastructure for a product that becomes increasingly difficult to differentiate. The central question is no longer whether AI works. It clearly works. The real question is whether the companies building it can convert technological progress into financial returns before their investment requirements become unsustainable. Alphabet has become the first major warning sign. Its businesses are growing, its cloud division is accelerating, and demand for AI capacity remains enormous. Yet the company still burned cash because building the future became more expensive than the cash generated during the quarter. For years, big tech companies were admired because digital platforms allowed them to grow without continuously building physical infrastructure. AI is reversing that model. The new technology economy looks increasingly industrial. It requires land, steel, concrete, chips, electricity, cooling water, transmission lines, and billions of dollars before the first customer sends a prompt. The companies may be constructing the most valuable infrastructure of the 21st century. Or they may be entering the most expensive corporate arms race the market has ever seen. We will not know the answer from user numbers, model benchmarks, or impressive demonstrations. We will know it when AI begins producing enough cash to pay for the machines behind it.